zoom out, remove the noise. If tomorrow is not going to be more digital than today, then start worrying. You can also worry at some point about the big cycles. So 2026 is likely to be a down year. Will that happen? I don't know. Most likely. Now, you can either hold on through the down years and keep adding and increasing the value of your portfolio, or you can unload some risk. Time for lifestyle chips are somewhere between December and March. We will obviously get more volatility in the space. Expect 30% pullbacks frequently, maybe 35%. These will happen. Maybe Bitcoin goes to 100,000 and then pulls back to 70,000 and goes up. Don't freak out about it. It's really normal.
Zoom out and cut through the noise. Today's pullbacks could pave the way for tomorrow's massive gains. That's the latest insight from Raoul Pal, CEO of Real Vision and a seasoned macro analyst. In a recent update, Pal shares key strategies for navigating the current market cycle and making the most of what he calls a one-time opportunity for investors. For Pal, the key to building long-term wealth lies in discipline and strategic planning, not chasing fleeting trends or succumbing to market hype. He emphasizes the importance of staying focused and resisting emotional decision-making during volatile times, offering a roadmap for maximizing gains while minimizing risks in this unique investment environment. Stick around until the end of the video as Raoul Pal shares more actionable tips on how to seize this opportunity and avoid costly mistakes that could derail your financial goals.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
The other key thing, the actual real hack to all of this, is just hold for a long time horizon. Just holding means you don't do anything. It's very difficult to make mistakes. You're self-custodying, you're not trading, you're not trying to scalp anything, you just hold it. And guess what? Over time, Bitcoin's done about 150% a year, including 3 kind of 70-80% drawdowns. And by doing nothing, you just compound the returns over time. I like to add to my bags into the big cyclical sell-offs, that once every 4-year down cycle. I like to add, and then your holdings compound and you make more and more money each time. But just have a longer term time horizon. For sure, look at the hourly charts. It's fun. I've got them up all of the time, but I don't trade them. I just hold. I barely do anything. I make a couple of asset allocation switches in the entire cycle, and that's it. And magic happens, and it stops you fucking up. So try your absolute best not to do anything with your main holdings. Also, zoom out. This space is all about noise. It's called FUD, fear, uncertainty, and doubt. You will find that somebody somewhere is trying to scare you, telling you it's a scam, telling you it's going to collapse, telling you something is going to happen, the Chinese are going to do something, the Russians are going to do something, something's going to go to war. All of these things are going to come across your screens every day, and they will make you feel insecure. Remember, this is noise. This is an adoption of technology. And if tomorrow is going to be more digital than today, we will use blockchain rails for proof, for social proof, consensus proof of value, of transferring assets, of holding assets. Everything in a digital world is going to require blockchain rails. It'll be equity markets, bond markets, currency markets. It'll be art. It'll be tickets. It'll be anything, any contract is better on the blockchain because you don't need a trusted third party because the consensus mechanism allows everybody to trust it. So over time, the adoption of Bitcoin is huge. In fact, it's still growing at twice the speed of the internet. Back when the internet was in its early days. So something that grows at that speed also goes up in price. So zoom out, remove the noise. If tomorrow is not going to be more digital than today, then start worrying. You can also worry at some point about the big cycles. So 2026 is likely to be a down year. Will that happen? I don't know. Most likely. Now, you can either hold on through the down years and keep adding and increasing the value of your portfolio, or you can unload some risk. And we'll talk about some of that. Don't forget, en route, make sure you take some lifestyle chips off as well. This is a really important concept. I've got another video on this, but lifestyle chips are the ability to take off some profits in things that really matter to you. So if the markets turn around, you don't time the top properly or whatever you're trying to do, you've paid off a mortgage, or you bought the car, or you bought the holiday. You've done whatever it is that you need for your own life. And you're going to hate selling out when you have to take some lifestyle chips off. But at the end of it, your future self will thank you massively. So make sure you think about that. The time for lifestyle chips are somewhere between December and March. We will obviously get more volatility in the space. Expect 30% pullbacks frequently, maybe 35%. These will happen. Maybe Bitcoin goes to 100,000 and then pulls back to 70,000 and goes up. Don't freak out about it. It's really normal. But remember to take some lifestyle chips off at some point. And the other thing is buy the fucking dip if you can. So if it does sell off 35%, you've got a bit of extra cash, buy it if it's not the end of the cycle. If it is the end of the cycle, then you wait till it goes down 70% or so, and then you pile in as much of your savings as you can on top of your existing holdings and let the magic compound over time. Let me tell you a little bit about that, because I've learned that the hard way. So the mistake there was I bought Bitcoin at $200 back in 2013. Amazing. I then rode it all the way down 85% because I knew it was a long-term bet. It then went back up in 2017 and it was trading about $2,000. And there was some FUD, the forking of Bitcoin into two different Bitcoin blockchains. And I was like, I don't really understand what's going on. And so I sold out. So it was the FUD that got me. And I then had sold out. But I was pleased. I'd made 10 times my money. Great trade. I thought, I'd done it well. It then went up another 10x in the last 5 months of the year, which was unbelievable. I've never seen anything like it. I missed that, but I was fine because I'd taken money off the table. I'd taken my lifestyle chips out. So I felt pretty comfortable. The market then falls all the way until 2019. So that was the down year of 2018. And 2019, I started looking at it again. And really in 2020, during the pandemic, when it fell 50%, is when I got back in. I think I averaged in about 6,500, and I'm still long to this day. Okay, so that looks pretty good. I bought it cheap. I sold it expensive. I bought it back cheap. But when I looked at it, and I bought a lot more at the end, the second time around in 2020, when I go back and look at, if I just held my original bet, which was much smaller, I'd have made 5 times the money from trading it. You see, that's the issue here. Now, had I listened to myself and bought the big sell-offs and doubled up my position every 4 years when we had the down cycle, I'd have 25x'd my position. And again, you can only do this in the very top tokens, mainly Bitcoin, but maybe Solana, Ethereum. But really in Bitcoin, that's where you can do this very long term, because Bitcoin is much more secure as an asset over time in terms of its adoption and acceptance at large. Then you can diversify out into riskier stuff. But buying the dip would have made me a fortune. The FUD cost me money. Trading cost me money. I didn't do the hold. You see, so there's a number of ways you can fuck up. You can lose your tokens. That's when an exchange goes down. Or you start using DeFi and you put your money for a yield into some stupid shit, which is what people did in Terra Luna. And again, I did not do that. Or BlockFi or Celsius or all of these things. Everybody lost money because they parted with their tokens. Storing in the wrong exchange. OGs remember Mt. Gox. They still have been paid out. That was, 10 years ago. So that's why I don't like to keep things on exchange. Hold on, let the gains compound. I've also screwed up by having this big diversified bag where I thought, all of my tokens will go up, and I tried to asset allocate. That screwed up, and I've got a wallet of shame like most of you have. And that failed. A lot of people have got wallets of shame from the NFT craze in 2021, and many of you will end up with a wallet of shame from the meme coin craze. So in meme coins, keep it to a small weighting, please. It's great fun. Get involved. But if you've got too big a weighting, you risk losing everything. And then you fucked up with rule number 1, which is don't lose control of your tokens.
Bitcoin remains resilient even after a $2.6 billion options expiry, showing no signs of losing momentum on its path to $100,000 and beyond. While some market watchers feared the expiry might trigger a price drop, Bitcoin has held firm. Before the expiry, it reached an all-time high of $99,512 but experienced a slight pullback to around $97,500. These fluctuations are typical during major events like options expiries. Options, essentially contracts allowing traders to buy or sell Bitcoin at specific prices, often introduce volatility as they expire. During such periods, the market can experience short-term shakiness as traders rebalance their positions. Despite this, experts remain confident that this expiry won't derail Bitcoin's ongoing rally and long-term upward trajectory. Now, let's return to Raoul Pal's insights on navigating this extraordinary market opportunity.
So this tweet says, remember, no leverage. So what that means is if you start borrowing money against it by using perps or other means, you have a risk of losing your coins if you get something wrong in a pullback. And then if you lose your coins, you're out of the market and you have fucked this up. So please don't use leverage. Leverage is for experts and shorter term traders and people who really know what they're doing. Even then, I personally never use leverage. My job is not to lose my coins. Secondly, no FOMO. That's the fear of missing out. You see, when things get crazy in crypto, somebody on Twitter or one of your friends will be making more money than you. In fact, it looks like everybody's making more money than you and you don't have the right trades and you're feeling terrible about yourself. That is just the engagement trap that is Twitter or the boasting of your friends. You don't get to see the trades that aren't working for those people. Now, really what it's about here is not doing stupid things. So not suddenly FOMOing into a trade because something else is going up more than your coins. That's an easy way to lose money because you end up usually getting into a trend too late. It then reverses, you've then lost money, you then try and get back into your old trend, your old trade, that starts outperforming and so on and so forth. It's a mess. Don't do it. The other really crucial one is only have 3 to 5 of the top assets in your main holdings. This is to de-risk. You see, the space is going to go up plenty. You don't need the fastest horse in the race. You need just good, fast horses. So for most people, just Bitcoin is good enough. Or maybe you want Bitcoin and Solana, because Solana has been, the blockchain with the most network adoption this cycle. Or maybe you have Bitcoin, ETH, and Solana. And then maybe you want to go a little bit further out the risk curve, whether it's SUI or Celestia or Say or whatever that one is for you. But remember, don't have that as your main holding because, again, we don't want to fuck this up. And the others are proven over time. They have Lindy effects. They survive. And I want you to survive. So don't have this broad portfolio. Now, I've done the broad portfolio trade as well. And I fucked that one up. So last cycle, I started off thinking, I don't know what I'm going to do. I'm going to buy a large basket on top of my Bitcoin holdings. So I had Bitcoin, and then I had a large basket of 10, 15, 20 different names thinking, well, these will work. Over time, my basket should work. It ended up being a wallet of shame. Most of those didn't work. I got a couple right, but they didn't really pay for the losses. It left me unfocused. I wasn't focusing on what really mattered. And it was my Bitcoin bet and then my switch into Ethereum. That was a big bet. But that wallet of shame is something you'll all go through, but try not to do it. Try not to go too far out the risk curve into mid-size and smaller caps and hold a big basket of those saying, well, the AI theme's going to play out and the meme theme's going to play out and the real world asset theme's going to play out. I want an allocation to all of these. It generally doesn't work. Honestly, it is not easy. So don't try and be a genius. Just let the secular bull market rise the value of your wealth. That's what I'm trying to do here.
Raoul Pal encourages investors to remain calm and tune out the noise. The crypto space is often flooded with fear, uncertainty, doubt, and excessive hype, but Pal advises focusing on the bigger picture. Digital adoption is accelerating, and blockchain technology is becoming an integral part of the global economy. He views this market cycle as a transformative opportunity to change lives, but only for those who stick to smart, disciplined strategies. Pal stresses that success requires resisting the pull of fear and greed, staying focused on long-term goals, and leveraging the immense potential of this rapidly evolving space. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.